All right, today we're going to tear apart a real data-driven trading strategy. We're going to go right under the hood to see exactly how it was built and, the most important part, how we can actually tell if it works. Let's dive in.
This is the big question, isn't it? Can you really use data and logic to find some kind of repeatable edge in what looks like just random market noise? Well, this case study tries to answer that by building a set of super precise rules to do exactly that.
So at the very heart of this entire strategy is one single, really powerful idea from finance: mean reversion. And this isn't just some random guess. It's a specific, testable hypothesis about the way prices tend to move.
So what exactly is mean reversion? Well, think about it like a rubber band. You can stretch it way out, but it always wants to snap back to where it started. This theory says that asset prices kind of work the same way. After a huge move away from their average price, they have this natural tendency to want to return to it.
Okay, so how does this case study take that big, broad theory and actually use it? It gets really specific. The hypothesis isn't about just any old asset. It's laser-focused on the Euro-USD currency pair. And it's not looking at just any average, but a very specific 20-day average. And the key belief is that this whole pattern is strongest when the market is calm and not really trending.
So, with that clear hypothesis in hand, the next step is to turn all that theory into practice. And that means building the machine, a strict set of rules that tells you exactly what to do and when, taking all human emotion and guesswork right out of the equation.
Now, this slide shows a really key principle in action: confluence. See, the strategy is smart. It never, ever relies on just one signal. It waits for 3 different conditions to all line up at the same time. First, you need a big price move. It's got to be at least 1.5 standard deviations away, which is just a fancy statistical way of saying unusually far from its average. Second, it uses an indicator called RSI to look for signs that the momentum of that move is starting to run out of steam. And third, it uses another tool, the ADX, to make sure the overall market is pretty calm and not in some crazy powerful trend. Only when all 3 of those lights turn green does it even think about making a trade.
Look, getting into a trade is only half the battle. Knowing when to get out is just as crucial, maybe even more so. And the exit rules here are crystal clear. The profit target makes perfect sense. You get out when the price goes back to the average. The stop loss is a hard line in the sand for risk management. And that time-based exit, that just makes sure your money doesn't get stuck in a trade that's going absolutely nowhere.
All right, so the rules are defined, the machine is built. Now for the moment of truth. The strategy was backtested on 5 full years of daily Euro-US dollar data, all the way from 2018 to 2022, just to see how this idea would have actually held up in the real world.
And the first number that just jumps off the page is the win rate. At 68%, we're talking about more than 2 out of every 3 trades being profitable. That's a really strong sign that the strategy might have a real statistical edge.
But hey, a high win rate isn't the whole story, right? We also have to look at the profit factor. And a number like 2.3 is huge. It means for every single dollar the strategy lost, it made back $2.30 on its winning trades. That tells you the wins weren't just frequent, they were also meaningful.
This next number is all about playing defense, risk management. The maximum drawdown was only 4.8%. Just think of this as the absolute worst losing streak the strategy ever had, the biggest dip from a peak in the account. Keeping this number low is absolutely essential for surviving long term.
So when you put it all together on one dashboard, this is what you get. You can see it was really picky, only taking 87 trades. The win rate and profit factor are super strong, and that drawdown is nice and low. And finally, that sharp ratio of 1.8, which basically measures how much bang you get for your buck risk-wise, is considered excellent. On paper, these results look pretty close to perfect.
And that's exactly the question you should always be asking yourself. When you see a backtest that looks this clean, you need a healthy dose of skepticism. Come on, it's easy to build a strategy that looks amazing on past data. The real test is whether it actually has any power to predict the future. And this brings us to what might be the most critical phase in any data-driven design: validation. You can almost think of this as the scientific peer review process. It's designed to make absolutely sure the results aren't just some random fluke or a trick of the data.
Because the number one danger here is something called overfitting. This is what happens when you tweak your rules so perfectly to fit the historical data that you've accidentally just modeled the random noise, not the real pattern underneath. An overfitted strategy looks incredible in the backtest, but completely falls apart the minute it sees new data it wasn't designed for.
So how do you actually check for that? Well, the method used here was to split the data. The strategy was built and fine-tuned using only the first 70% of the historical data. Then, the real test was to unleash it on the final 30% of data that it had never, ever seen before.
The results of this test were the real validation, the moment of truth. The performance on the unseen, out-of-sample data almost perfectly mirrored the performance on the original training data. And that is a huge sign that the strategy actually captured a real, repeatable market behavior, not just some historical noise.
And that brings us to the final validation number. The strategy maintained 83% of its performance when it was tested on brand new data. That right there is the hard evidence suggesting this thing is robust. And its statistical edge is probably genuine. In other words, it passed the peer review.
So, after breaking this whole process down, what are the key lessons? What can we actually learn from this data-driven approach?
3 big lessons really stand out to me. First, the power of confluence. Never, ever rely on just one data point. Combining checks for price, momentum, and the market environment created a way more reliable signal. Second, validation is everything. It is the one crucial step that separates a real, durable edge from just getting lucky on a backtest. And finally, simplicity works. The strategy's clear logic, all based on one core idea, made it way more robust than something that's been overcomplicated and over-optimized.
And that leaves us with one final thought. This entire process was a masterclass in using historical data to find an edge. But we all know markets change, they evolve. So the ultimate question is still out there. As technology moves forward, what new data sources, what new techniques, maybe even things like machine learning, are going to be used to build the strategies that predict the future?